My name's Khue Dang, and I'm a certified mortgage planner. I work for W.J. Bradley, and I've been in the industry for over 10 years. If your borrower or if your buyer already is working with somebody that they trust and know and is providing them good information, is a good communicator with them, then they should be able to utilize that person. Otherwise, the real estate agent is a great resource. Oftentimes they can give more than one referral as well, and the buyer should actually interview them and get to know who it is and go with their gut feeling on who will work well for them. It depends on really the type of loan and the individual. Right? You can get government loans, which are FHA loans, all the way up to the super jumbo loans, and down payments could be as little as 3.5% all the way up to 30%. So again, depending on the program, the individual, and all the aspects that roll in it, that's why the mortgage planner in person would be really good for them to talk to previous to even going out and seeking a real estate agent. And people are kind of scared of the ARMs right now,
Right.
but there's nothing to be scared of if you understand what they are. A fixed rate, 15-year fix, a 30-year fix, a 20-year fix. They are where your rate, if that's 5%, stays at that rate all the way through the 30 years. So your principal and interest payment never changes in the full 30 years. Now, if it's an ARM or variable rate, then it may change depending on the terms. So if it's a 3-year ARM, 5-year ARM, 7-year ARM, 10-year ARM, take an example, a 5-year ARM, the fixed rate remains that rate, let's say 4%, for the 5 years. After that, once a year, it may change. And that is a 5-1 ARM is what they call it. So once a year, it's tied to like the LIBOR, and then with a margin, and you add the two of them together, and you get what your new interest rate is. And they usually let you know kind of what that is going to be about a month before the actual change. Points have been misconstrued big time in the industry right now. So in points, they can actually get your interest rate lower. They can actually help get you to a certain payment so that you can qualify. Points can be used when a seller actually gives you extra money, and you can use it to get your rate to a certain point. So points are really a form to get your interest rate at a certain level. So if your 0 points out there, 0 origination. When they say points, they're really talking origination fee and discount fees. And so in points, it's really how many points you buy is directly correlated to what your interest rate's going to be. So you buy a lot of points, your interest rate will be lower. With that said, sometimes you want to actually evaluate what those points mean in relation to the cost, because if it costs you 10 years to break even in buying all those points, and you're only planning on being in the house for 5, most likely you don't want to buy all those points.
Absolutely.
So that's, again, something that a mortgage planner would be really useful for. Good question. So many different types of loans, so many loan options, so many programs in there. So an FHA is a government-backed loan. A VA is a government-backed loan that the military people have opportunity to receive. And the conventional loans are just your loan that everybody can get, anybody can get virtually. So the different types of loans will have different different down payment options. They will be different costs related to them, and they'll have different guidelines that will meet those particular programs. So your best bet is really to talk to a mortgage broker or a certified mortgage planner who can actually walk you through what your qualifications are, what your needs are, and which of those programs are going to be the best option for you.